This is the Resilient Advisor Podcast, the show for high-performing financial advisors. We bring you the best practices of the industry's top performers so that you can build resilience in your business and your personal life. Here is your host, Jay Coulter.
Thanks for downloading this episode of the Resilient Advisor Podcast. Today, I'm interviewing Alternative Investment Portfolio Manager John Farley, who works with Emil van Essen, which is a Chicago-based CTA firm. Here's the disclaimer. Nothing discussed on this podcast is to be considered investment advice. As always, if you use any information from this podcast to manage money, you will lose all of it and look like a fool to your clients. John, thanks for coming on.
How's it going?
All right, so John has over 20 years of experience in option making, prop trading, portfolio management with currencies, equities, and commodities. I wanted to bring him on the podcast to help listeners understand some of the complexities in that space, particularly with alternative investments, and how, if you're not careful, you can end up hurting your clients' experience with the portfolios you build for them. So John, our audience is high-performing financial advisors. They have sophisticated clients and they're always looking for a competitive advantage or a differentiator for their portfolios. So given your robust background, let's talk about how they could potentially hurt their clients in the alternative investment space through the lens of this conversation, and maybe just talk about the different product structures that are available.
Yeah, I would say the biggest pitfall to avoid would be investing in generic type alternative investments. I think you're going to want to do your due diligence when researching particular managers in that space. I would say that's very important.
Yeah. So I think a lot of the listeners have off-the-shelf products from their firms that they have to look at. And you're operating in a completely different space, more of an institutional space, but it's still the CTA structure that they have access to at their firms. Tell us a little bit about the problems and the advantages of using the CTA structure and what it looks like.
Right. Well, I think CTAs were born out of a need or demand for people to maintain their own accounts and invest small amounts of money in strategies that would generally be used in large hedge funds. So it enables people to invest in hedge fund type strategies on a small level, which is great for small investors. So what were you?
Well, let's talk about the fees in there. So in my experience, most of the off-the-shelf products that our listeners have access to, they're 2 and 20 structures. What do you think of the 2 and 20 structure, and why is that so prevalent inside the CTA space?
Right. So the CTA space, it's essentially a hedge fund space. So people look for that 2 and 20, performance fee, management fee structure. Although that has been declining in recent years as the space has gotten a little bit smaller. It went through a great growth period in the late 2000s, and it's shrunken a little bit since then. But new managers tend to take lower fees, and that can be worth the risk sometimes if you find one that resonates with what you're looking for.
Okay. Let's talk about the new manager dynamic. There's significant research out there that speaks to the performance of smaller or newer CTAs and their ability to deliver alpha versus the larger funds. Could you talk a little bit about that?
Yeah, I think as a fund grows, they tend to get saturated in their strategy, meaning they take on more capital, and there's a sort of law of diminishing returns in the scalability of what they can do. They tend to look for new strategies to deploy the new capital that they get, and they're not always the best in those new strategies. So, newer managers tend to trade strategies that may or may not be unique to the market. They're usually ideas that are new ideas as opposed to old ideas, and they can pay off accordingly.
If an investment advisor is building out a portfolio with an alternative sleeve and they want exposure to commodities specifically, is there particular CTA strategies that would best fit that type of exposure, or am I asking the question wrong? Is it more of it's a hedge fund and the manager's going to go where they want to go?
Yeah, I think each client is going to be unique, right? I imagine each client would want to have different exposure to different markets. Some clients might just want to be long commodities. They might want to be long energy. They might want to be long, softs or metals or grains. They might want a complete portfolio of all those things. They may want the ability to have a manager go long and go short. They might want to have a guy that uses timing to show a return stream. Some guys might want a completely and unique alternative investment, say in something like I do, where it's a volatility portfolio. Our return stream is based on market making and liquidity providing alongside a cross-asset volatility book, which is completely uncorrelated to really anything. I think it all depends on what the investor is looking for, and if they do their due diligence on the manager, they could find one that they trust and like, and it could be good.
So specifically, if an allocator, a financial advisor, is looking to get exposure to energy, they're not necessarily going to get beta for energy using a CTA. They're going to get a trading strategy that is using the energy markets.
No, that's not true. I mean, the CTAs come in all forms and fashion. There are systematic CTAs which employ very strict rule-driven trading. They use computer models to generate signals to go long and short commodities or baskets of commodities. Other CTAs are discretionary, where there's a manager who makes decisions based on his discretion, and he uses whatever tools he uses, but there's no computer giving him signals. Other CTAs, like the portfolio I manage, is a market making CTA. We don't necessarily make market timing bets. We provide liquidity and trade volatility. So they come in all forms and fashions, and I think it just really depends on what your client would be looking for.
Okay, so you could get beta of energy using a CTA.
Absolutely, you could have a portfolio of CTAs, which I think people do, where one account is beta, one account's alpha, and one account is uncorrelated.
Okay, let's talk about other structures that advisors could use to get that commodity exposure. Starting to be more conversations around it now because of where they are in the cycle. It's time to start looking at them again. Let's talk about futures contracts. And I want to preface this that, in 1999, I ran across a lot of friends that decided they could quit their jobs and start day trading, and that didn't work out. And then ran across folks here in 2007 that kind of thought the same thing with real estate. I'm now finding more and more people opening futures contracts and day trading for themselves, and that's not their field. Tell me how that person's going to get hurt trying to do that, and so that the listeners, their clients, might be getting pushed into that space as well.
Yeah, I mean, day trading is essentially a short-term gain. You really can't beat the market these days, especially with the advent of the algo and HFT firms. They've replaced the traditional specialist per se, or the traditional market maker on the exchange floor. The HFTs are now the defunct specialists, and they use lightning fast computers to make markets and gain exposure to the liquidity or the order flow from the retail investor. So as a day trader, your order is hitting the market much later than the algos and the HFT firms. They see your order and they essentially have the ability to front run it. So day trading can show short-term profits over short periods of time, but it's very difficult to have a consistent track record day trading if you're doing it on a generic trading platform at home or at an office.
And you want participants like that in the market because that's how you make money.
Right. So we are not an algo or HFT firm, but we are a liquidity provider. So I can speak to the methodology behind what those firms do and how they do it. We do it in an over-the-counter voice broker market. We do provide liquidity electronically on the CME. That's one of the things that we do. So we can speak to that, but we don't. It's not high frequency. So we provide liquidity to brokers who have clients. We provide liquidity to clients direct to oil firms and speculators and hedge funds who have a need for the securities that we trade. So we have an advantage in the sense that we are providing the liquidity and a retail investor is not. So that's how we generate our alpha.
Or said differently, you're making money off those fools that are going into the markets thinking that they can.
Yeah. I mean, I wouldn't call them. I mean, they make money too, but they have typically they're hedgers. They're a pipeline company that has exposure to a price differential across the crude forward curve, and they need to hedge that exposure, and they'll use options to do that.
I'm thinking more specifically of the retail investor, somebody who has an account with a financial advisor managing their finances, and then they decide they're going to go trade futures contracts on the side.
Yeah, I think a retail investor, if he wants to be long or short a market, could utilize the option market where he would be giving up an edge, or he would be losing a little bit by trading options to a liquidity provider, but that option position may be hedging a futures position that he has, and that can be beneficial. Day trading the futures in and out over a short period of time is almost certainly going to lead to losses.
That's the line right there.
Yeah.
It's going to lead to losses.
You may have short-term benefits, and I would make the analogy that it's no different than going to the casino and playing blackjack or craps. You can certainly win on any given night, but if you keep going back over and over again, you will go broke.
Yeah.
So I think people should keep that in mind if they have clients that want to day trade really any market these days. You have a big competitive disadvantage, and it's a big one. So be careful.
Let's talk about ETFs. They've become incredibly popular in the advisor community as allocators to capture beta. There's some active ones now. These commodity ETFs, they've been around for a while now. I think the first one was filed back in 2007. They've raised some money, especially during the run we had a couple of years ago in the commodity space. Give me your thoughts on broad-based commodity ETFs and then individual siloed ETFs in the commodity space.
So if you or your client has the ability to trade in the futures markets, I would say that's almost always preferable over an ETF. Given the ETF's fee structure, the cost of the ETF to roll their positions over certain time frames, all lead to disconnects between the return stream of the ETF and the return stream of the actual commodity. You can trade futures and literally get the raw return stream of that commodity with very little cost associated with any that you would get in an ETF. So now I understand that some people don't have exposure or can't get exposure to the futures market,
or their account's just too small.
Yeah, so in that case, an ETF may be acceptable if you really want to have exposure to that. Now, there are other ways to invest in commodities outside of ETFs, so you could look at those too. Sort of the Sprott management gold. I guess that's an ETF too. So, but you don't need a lot of money to trade futures. You actually don't need that much.
But for the portfolio manager allocating, if they use a broad-based commodity ETF, there's some drawbacks to it, right? They're not necessarily going to get the exposure. You and I were talking about this pre-interview with the contango that comes in.
Yeah, so many all commodities have forward curves, and that forward curve represents usually cost of carry, or it represents interest rates. When a forward curve is in contango, it means the futures that are in the front months or in the spot month are lower priced than the futures farther out in time. So if you are a long only fund, you have to sell the front month future as it's going to expire and buy a back month future. And if the futures in the back are more expensive than the futures in the front, then obviously that cost of that roll is going to add up over time, and it's going to dilute your return. If you can invest, say, in crude oil, and you can buy a future that's 10 years, or not 10 years, but say 4 years out, and you can own that future for 4 years, as opposed to rolling it every month. So there's different ways you can take advantage of the forward curve in a commodity space. It can hurt you sometimes, but it can also work to your advantage.
So if you're building a portfolio for $1 million client, and you think that now is the time for commodity exposure, it's a tactical play, not a strategic play, do you think the broad-based ETFs could deliver what you're looking for? Meaning you're making it, it's not something you're going to hold for 10 years. It's a decision that now's the time to have a tactical allocation to commodities.
Yes, certainly. They certainly would work fine in that regard. I mean, the shorter you're going to hold the investment, the more suitable an ETF is, I would say.
Yeah, especially for non-beta. Based on my experience in the ETF world, I think a lot of those were sold to investors as a strategic play, and it just doesn't work out that way. Yeah. Is that going to be the same for the single sleeve commodities? An advisor gets a call and they say, hey, Trump's going to be president. We want to go long oil. We're going to go buy USO. Is that a bad decision? And I'm not asking you to comment specifically on that ETF, but the single sleeve.
Yeah, ETF. Again, if you have exposure or you can gain exposure to the futures, it's always better because it's just going to cost you less. Mm-hmm. A crude oil future has a margin of around, I'm not sure what the exact number is, but let's just say it's $5,000 for a notional value of, say, $55,000. Now, if you go buy the ETF and you wanted to deploy $55,000, you have to deploy $55,000. Mm-hmm. So you could put the extra $45,000 to work in a T-bill.
Yeah.
So
that's probably not as applicable to our listeners because they have to allocate inside of an account.
Okay.
So what I'm hearing, just to be clear, if you think that over the short term you want to have exposure to oil, an oil ETF would work, not necessarily deliver.
Yeah, I mean, it's highly correlated over the short term to the futures market.
Okay.
Yeah.
Awesome. John, thanks so much for coming on. I really appreciate you being on the Resilient Advisor podcast. You come back on anytime.
Thanks, Jay. Thanks for having me.